Welcome. Today we're going to be discussing events after the reporting period, which is covered in International Accounting Standard 10. This video is going to be focusing on adjusting versus non-adjusting events and the principles around what is an adjusting, what is non-adjusting, and what you have to do with those two types of events. So to start off, we're going to discuss this in terms of a timeline with two major dates. The first date is being your year end, your reporting date, and the second date is going to be the date the annual financial statements, the AFS, are authorized for issue. Okay. Now, in between those two dates, you may have different events that occur. We'll call that the post-reporting date, RD, event. Okay. That may be inventory that's damaged after year end, or after year end you find out that a debtor is no longer going to be able to pay you, etc., etc. Now, there's going to be one of two types of events. You will either have a post-reporting date event that will be an adjusting event, i.e., it will result in the financial statements at reporting date being adjusted, okay? And you will do an actual adjustment to the annual financial statements. The second type of event is a non-adjusting event. Now, a non-adjusting event will result only in disclosure. So you'll only disclose in a note. So when I say you'll only disclose in a note, it means you will not adjust the annual financial statements. Okay, so what causes the difference? We'll discuss those now. So let's start off with our adjusting events discussion. For adjusting events, there must be evidence of conditions that existed at reporting date. Okay, irrespective of whether or not the fact was actually known at the end of the reporting period. And as I mentioned a short while ago, you will actually adjust the recognized amounts in the annual financial statements. There will be a change in the statement of financial position, balance sheet, or a change in the statements of profit and loss and OCI. Okay, so here a good example would be you have your reporting date, you have the date the annual financial statements are authorized, but then you have a post-reporting date event. Let's say, for instance, that you find out that one of your major clients, one of your customers, has gone insolvent, okay? And you had a debtors balance at year end of, let's say, $1 million. But then you find out that of this, your debtors, okay, you're going to have to write down 150. The question is, will you have to adjust, or will this be a non-adjusting event? Well, let's find out why the debtor went insolvent. Well, we find out that it was via the news that you became aware of your client being liquidated. But this scenario was already in existence at reporting date, i.e., once the information came out after year end, it was clear that the customer was already insolvent before your reporting date. Okay, well, that is clearly evidence of conditions that existed at reporting date, and therefore you will adjust the 1,000 down by 150. Okay, so some other examples are given in IAS 10 paragraph 9. This is by no means an exhaustive list, but there may be settlement of a court case after reporting date that confirms the entity's present obligation at reporting date. Okay, so initially you thought this was just a contingent liability, but after year end the court case is settled and confirms the present obligation. Okay, therefore you go and raise the full liability at reporting date. There may be discovery of fraud or errors that existed at reporting date. Also, your determination or finalization of profit shares or bonuses that are payable after reporting date. Here's a catch though. If the entity had an obligation to make such payments at reporting date, i.e. they were contractually obligated already. Okay, so moving on now, non-adjusting events. Well, these are indicative of events that arose after reporting date. They are unrelated to conditions that existed at reporting date. There are no recognition adjustments. A little trick there later on, only time you will adjust if it affects the going concern basis of presentation, but that's for a later video. Then you will disclose in a note only, i.e. you will not change the statement of financial position, but you will do a note and disclose the nature of the event, the financial effect of the event, or a statement that the financial effect could not be determined. Okay, so the little example here would be you have reporting date, financial statements are authorized for issue, and your reporting date or your post-reporting date event. Well, let's say that a whole bunch of inventory was damaged. So inventory was written off because one of your warehouses burnt down. But please, let's consider, did that affect or did that arise or affect conditions or circumstances that were in effect at reporting date? Well, that's definitely a no. It arose after year end and they were unrelated to conditions that existed at reporting date. So therefore it is non-adjusting. Okay. Now throughout the standard, mainly in the disclosure paragraph, paragraph 22 of IAS 10, a couple of other examples are listed. 3 of them I've just listed here. There may be acquisition or disposal of a subsidiary or business combination after reporting date. That is non-adjusting. There may be destruction or impairment or write-off of fixed assets or inventory after reporting date. Well, not related to circumstances at year end, ladies and gentlemen, so that is non-adjusting. There may be litigation resulting from events that occurred after reporting period. Therefore, there was no obligation at our reporting date. Therefore, it is also non-adjusting. Okay, this list is by no means exhaustive, but it starts giving you some guidance as to what will be adjusting versus non-adjusting. Great, I hope this makes a good start for us. Please read through the textbook and the standard IAS 10 on this. It will just give you the full set of information so that you really bed this topic down. Okay, it's one of the easy ones. Get it right first time. Thank you.